At this stage in our income statement construction discussion, we've gotten from the revenue line all the way to the effective gross income, which is also known in my world as the net revenue line within the income statement. From that, we now need to consider our operating expenses. And so the operating expenses are a simple deduction from the effective gross income. And generally speaking, operating expenses are nothing more than the expenses that are regularly occurring specific expense line items associated with ongoing property operation. So it's important to note too that when we talk about operating expenses in my class, when we talk about the individual line items, we talk about things like real estate taxes, real estate insurance, utilities, janitorial, and there's a laundry list on both apartments and commercial. Students would always raise their hand and say, how about depreciation? And at this stage, this is a cash flow statement, and we're not contemplating income tax consequences. So the depreciation line item is not something you will see at this stage of our pro forma income statement, because the fact that that's a income tax line that is unrelated to what we're talking about right now. Now, within the operating expense section, there are fixed operating expenses and there are variable operating expenses. A fixed operating expense says that even if the building were 100% vacant, you would incur the entirety of the expense. So an example was always the property insurance. So even if the building was completely vacant, you would be paying the property insurance bill. Now, the bill could be a little bit less because you don't have tenants in there, but for all intents and purposes, that property insurance bill is independent of the occupancy of the building. Variable operating expenses, however, are highly dependent upon the occupancy of the building. So we could think about electricity as an example. If the building were completely vacant, you'll still use some electricity naturally, but you will not use the same level as if it were completely occupied. So a fixed versus a variable expense is dependent upon the occupancy of the building. And again, examples of a variable expense would be janitorial, it would be utilities, meaning that the level of those operating expenses is highly dependent upon how well occupied the building is. Also, you have controllable versus non-controllable operating expenses. So we've already discussed the fixed versus variable. Controllable versus non-controllable has to do with how much control the owner of the property has in the expense level. So the easiest ones to start with are non-controllable. So non-controllable operating expenses would be property taxes, property insurance. The reason being is the owner of the building has very little to no control over ultimately how much he or she's going to be paying in property taxes every year. That's really the domain of the property tax assessor. The owner of the building really has no control over how much they pay in property insurance. They can go to different providers, but at the end of the day, they have to pay for the property insurance, right? Because you can't have an uninsured building. Controllable operating expenses are the expenses that the landlord has complete control over. So again, we could elect to turn the utilities off, right? So we could do that. It would be very disadvantageous to you as the owner because the tenants will get very upset because they have no more water at the property, but the fact remains that it is under the control of the owner of the property. So just to recap, operating expenses, again, are regularly occurring specific expense line items associated with the ongoing operation of the property. You have a fixed expense and a variable expense, which relate to the occupancy of the building, and controllable versus non-controllable, which relates to the owner's ability to impact the level of the expenses. At this point in a pro forma income statement, we've taken the revenue, we've subtracted the impairments, we've gotten to the effective gross income line, we've subtracted our operating expenses, and now we are at the net operating income line. The net operating income line is often utilized as a shortcut to determine the value of a piece of real estate. So owners and prospective buyers will and can assess the value of a real estate asset by simply taking the year one NOI from the pro forma. So when you're projecting your pro forma income statement, they would take the year one NOI and they would divide that by what we call the capitalization rate. So in the real estate valuation terminology, you have the going in capitalization rate, which is the year one NOI over value, and you have the exit capitalization rate, which is the year N plus 1 NOI. So if the whole period is N plus 1, it's the year after the whole period. So if you're holding it 5 years, it's the year 6 NOI divided by the residual value. So there is a valuation approach known as the direct capitalization approach, which simply takes the year one NOI, the net operating income in our pro forma, and divides it by a capitalization rate. So a capitalization rate, again, is the year one NOI over value, or to determine value, it's take the year one NOI and divide it by the market cap rate, the market capitalization rate. Now, if I could take a minute just to talk about the market capitalization rate. Think about the market capitalization rate as an indication of relative expensiveness or cheapness. So as a cap rate goes up, the value of the real estate goes down. So as a cap rate goes up, and it's a percent, the value of the real estate goes down. So if you take the NOI and divide it by 5%, and if you take that NOI again and divide it by 6%, the value has gone down. So higher cap rates suggest higher risk. Lower cap rates suggest lower risk. So as cap rates go down, value goes up. So you could think about nationally today, across office, industrial, multifamily, a national cap rate might be 5% or 6%. That means on average, office, industrial, multifamily, retail across all areas within the country are averaging 5%, meaning if you would take the year one NOI divided by 5%, that would be a shortcut to determining what the value of the real estate is worth. The reason this NOI line is the line used to determine this valuation is because it is the last line of your income statement that has regularly occurring both revenue and expenses. If we think about our income statement, again, revenue minus operating expenses equals NOI minus capital expenditures, that's the next line in our income statement. Capital expenditures, remember, are things like replacement of the roof, replacement of the elevators, replacement of the chiller, the cooler, the cooling tower. These are expenses that occur once every 10 years, every 5 years, every 15 years. So the NOI line is the last line of regularly occurring revenue and operating expenses. When you get into the capital expenditure budget, the individual years could be highly distorted by a specific expense like the replacement of a roof that is incurred in an individual year. As such, this direct capitalization method is typically applied to the year one NOI because once we get into the capital expenditure section, there's a high degree of variability. The NOI line, the net operating income line, is also referred to as the line. So you'll often hear somebody say that's an operating expense, so it's above the line, meaning if it's above the line, meaning that expense is in operating expenses. You could hear somebody say, well, that's a capital expense, so that's below the line. Below the line means it's below the net operating income line, and you're seeing it in the capital expenditures. When we think about cap rate, generally speaking, is the NOI divided by value. We also use the phrase income yield. Income yield is the exact same thing as I described as the cap rate, and I use income yield and cap rate interchangeably. At this point in our income statement, we have gotten through the revenue, the impairments to revenue, effective gross income line, operating expenses, to the net operating income line. Now we're focusing on the capital expenditures. The capital expenditures are inclusive of a number of things. One is something known as a general reserve. And a general reserve is essentially money that you put to the building in the way of money that you allocate in your pro forma income statement that addresses smaller scale capital needs. So as an example, you might have a circumstance where a 20 square foot section of the roof of your apartment building blows off in a storm. The expense to fix that might be $2,000. That would not be something that you would itemize in your pro forma income statement because it's a very small expense. So we create this general reserve that's effectively a slush fund, if you will, to capture these smaller capital items that you would not anticipate necessarily, as the example of the shingles blowing off the roof, but that are also quite small. Now, in the apartment space, I've seen owners and investors underwrite $250 per unit as the general reserve. So you'll often see the apartment general reserve line as $250 a unit. On the commercial side, it's a square footage expense. So industrial buildings, for instance, you might underwrite 10 cents per square foot times the total square footage of the building as your general reserve. So if you have a 100,000 square foot building and you have a 10-cent reserve, you have a $10,000 general reserve for the industrial building. Now, as the complexity of the building increases, like to office, which is the other side of the coin, you might get up to 35 cents per square foot. So the general reserve on the commercial side can range something between 10 cents to sort of 35 cents. Within the capital expenditure section, you also have the leasing costs associated with the investment that you would have to underwrite. When we talk about leasing costs, we're talking about commercial assets only, office, industrial, and retail. There are no leasing costs, and as a result, there is no leasing cost line item within apartments. The leasing costs are comprised of two things, the leasing commissions and the tenant improvements. Tenant improvements, as an example, are taking a warm lit shell of a space, a space that you receive raw as the tenant when you sign a lease, and is money that the landlord gives to you, the tenant, for you to fit out the space. So when we think about the term fit out, that simply means we're going to take a very generic vanilla box and convert it into what the space needs to look like for you to occupy it. That's known as a tenant improvement commission. Now, tenant improvements can vary dramatically, but oftentimes for office, you might be talking about anywhere from $60 a square foot all the way up to $100 a square foot. So from the perspective of the landlord, this is very expensive, because if you assume a large lease and you're giving $100 in a tenant improvement allowance, that's a lot of money that is transferred from the landlord of the property to the tenant. So within the leasing costs, we have the tenant improvement capital. We also have something known as the leasing commission capital. And the leasing commission is money that we pay to the leasing broker. The leasing broker's job is to identify tenants and bring them to buildings that are in need of tenancy so that a lease is consummated. The landlord must pay the leasing broker naturally for that service, and they pay that individual in the way of what is known as a leasing commission. So the final element of the capital expenditure line, in effect, that you are deducting from the NOI line are capital expenditures. These are major capital items, major capital improvements that are made to a building. So these are long-term improvements to the physical quality of the property, and these are highly variable, dependent on the product itself. So as an example, older office, as an example, is very expensive from a capital perspective standpoint because the physical elements of an office building wear out. So if we think about things like an elevator, elevators are very expensive and they wear out over time. The heating and the cooling, the ventilation, the HVAC within an office building is very expensive, very complex, and that wears out over time. So the amount of capital that you're going to be spending in a building for an older building is much more than you would spend in a brand new building because all the physical items within the building are new. So there's a high degree of variation in the capital expenditure line depending on the building itself. Now, when you're endeavoring to buy a real estate asset, you do, as the investor, the best you can to assess the relative age and life of the in-place aspects of the physical building, and then you try to price those out. But ultimately, you will engage an engineer, assuming that you're successful in being selected as the bidder, as the buyer of the property, to do a formal evaluation of all the physical aspects of the building so that you have a better sense or a more correct sense as to the relative remaining life of each individual physical element of the building. That then will allow you to do a better job at pricing out the total cost of the capital expenditure line. So we are very nearly done with the line-by-line discussion of our pro forma income statement. So if you recollect, we went from the revenue to the impairments to revenue to the effective gross income, subtracted the operating expenses to the net operating income, subtracted the capital expenditures. Now we arrive at what we know as the property before tax cash flow. And that line is present in both the apartments and the commercial assets. The property before tax cash flow line represents what the property actually is going to generate. Now, this line is before contemplating any debt on the property. It's before contemplating any income tax consequences at the property. And this line, this property before tax cash flow line, is the line upon which the unleveraged analysis, the unleveraged valuation, the unleveraged discounted cash flow is performed. So the property before tax cash flow line is the line upon which we perform the unleveraged analysis to determine what the building is actually worth. And this property before tax cash flow line also allows us to calculate what we know as the cash yield. So if you remember when we were talking about the cap rate and the NOI line, we discussed something known as the income yield. The income yield is the NOI of the property divided by value. The cash yield is the property before tax cash flow divided by value. And we use the income yield and the cash yield together when we think about the evaluation of an investment. So if we are looking to buy an older office building as an example, the income yield of that older office building may be attractive, but the cash yield of that investment, property before tax cash flow over value, is very unattractive. And the reason being is that the sole difference between the NOI line and the property before tax cash flow line is the capital expense in the leasing cost section. If you have a unattractive cash yield, that likely means, or almost assuredly means, that the building has a significant amount of capital expenditures and leasing costs that will be incurred. While it may be attractive at the income yield line, the NOI line, it may be an investment that you don't consider further because the cash yield is so low. And the reason the cash yield would be so low is that there's a significant amount of capital expenditure and leasing costs associated with the investment. So when we think about valuation, we use the income yield, the cash yield, and what we call the total return. That's the interest earned on the investment overall in concert to determine how much we pay for the real estate. The pro forma income statement has both operating cash flow and residual cash flow. Now remember, operating cash flow is the cash flow we receive from the tenants that are paying us rent on a monthly basis. The residual cash flow, also known as the reversion cash flow, also known as the exit cash flow, is the sale price of the asset. So if we buy a piece of real estate, we're going to own it, and inevitably we're going to sell the real estate, right? And this reversionary cash flow is a critical element of our valuation and can be a large part and large percentage of the property's present value. So very quickly, how do we determine how much we sell the real estate for? When we're creating this pro forma income statement, how do we determine what the residual sale price would be? And the first step of that process, number one, is to determine our hold period, project cash flows for the entirety of that hold period, and then extend that cash flow 1 year beyond our hold period. So if we're endeavoring to hold the real estate asset for 10 years, we project 11 years worth of cash flows, and we take that 11th year of NOI and divide it by the exit cap rate. So year 11 NOI divided by the exit cap rate is our residual value. Now you could ask yourself, if we're holding the building for 10 years, why on earth are we looking to the 11th year of NOI to determine the sale price? And the reason is, think about our sale. We are selling a building to a buyer. That buyer is going to be making his or her own determination as to what they will pay for the real estate. That determination is due in part on and based in part on what their year one of NOI is. So if you think about it, if we have 10 years worth of hold, the 11th year of NOI is the theoretical year one NOI for our buyer. And our exit cap rate, year 11 NOI divided by exit cap rate is our residual value. The buyer's calculus is the year one NOI divided by the going in cap rate equals their purchase price if we were to determine value through what we call the direct capitalization approach, which is a shortcut approach to valuation, as opposed to going through the discounted cash flow analysis that we are advocating here with this analysis. So that residual value is determined by taking the year beyond our hold period of NOI and dividing it by the exit cap rate, which ostensibly is our buyer's year one NOI divided by their going in cap rate. The primary things that we learned today, number one, is an introduction to what is a pro forma income statement at a very high level. Then we went through the process of identifying line by line what are the individual line items within the pro forma income statement.